Hello and welcome to my course on Economics for Business. This is module number 4 on economic data. So the objectives of this module are twofold. Basically, I want to introduce you to some basic types of economic data. I want to walk you through how they are constructed and also walk you through how you might use them in practical economics in business. And secondly, I want you to understand some of the sources of economic data, which we'll go through later. So I've managed to disaggregate kind of all economic data into two really broad types. This has come out of kind of some reflection on my experiences as a professional economist. Kind of the first disaggregation, or the first grouping I've made, is what I've called contextual data. So this is going to be very broad, very broad brush, big strokes, like how is the economy doing? What are some pieces of data that might answer that? So examples of kind of contextual data will be gross domestic product, inflation, and unemployment. And then the second grouping I've made is kind of the opposite end of the spectrum, where it's much more focused, and so I've called it direct data. So this is going to be describing very specific industries, or it could be describing specific areas. So it's going to be answering questions such as, how is manufacturing specifically doing? And some examples of these sort of statistics are value add, building consents, and kind of prices of specific inputs or specific commodities. So some commonly cited data in the contextual group, which we're starting with, are going to be gross domestic product, inflation, unemployment, population, incomes, and wealth. We're starting with contextual data, as I said, and I will explain kind of some direct data later. And for each of these pieces of data, I want to run through what the definition is, how they are constructed, and what their main use might be for kind of practical business economics. So we'll start with gross domestic product, or GDP. This is really that key statistic for understanding how is the economy doing. It's the one big statistic, it's the broadest statistic we have. So we define this as the total monetary value of all final goods and services produced within a country's borders over a specific time. That definition comes from some global organisations such as the UN and the World Bank, and kind of most developed countries have come to an agreement to use the same definition. So how do we construct the GDP number? Well, usually the statistical agency in the country you're looking at might be Statistics New Zealand, it might be the Australian Bureau of Statistics, or it could be any others. Anyway, what they're going to do is they're going to collect data on consumption, which is how much money is being spent on goods and services. They're going to collect data on investment, how much money is used for bridges, roads, buildings. They're going to collect data on what the government spends. Now this is government spending in terms of that consumption and investment. This is not government spending in terms of, say, unemployment benefits or pensions. It's just what they spend on consumption and just what they spend on investment. And then they're also going to collect data on kind of exports and imports. And then to calculate that one statistic, GDP, from these kind of 5 data series, there's a simple equation, which is just C plus I plus G plus X, and then you just minus M. And the reason you subtract M is to avoid double counting, because M, those imports, those are already included in consumption and in investment and in government spending, because consumers, investors and government all spend some of our money on imports, and so we have to subtract that off to get a proper estimate of the total value of goods and services that were produced domestically. As part of the kind of gross domestic product calculation process, there are some other approaches which we can use, which are also globally recognised, and they are the income approach, which is where we take all of the incomes that are earned by the different factors. So labour earns wages, businesses earn profits, and capital earns interest, and we sum all those together. And then there's a third approach, which is called the production approach, and that's where we calculate what's called the value add of each stage of production. So if you think back to our last module where we talked about stages of production, that's what I was referring to. And here the statistical agency will calculate the value add of each stage, and then we'll sum all of those and that will give us an estimate of the GDP as well. And theoretically, all three of these measures, the expenditure, income, and production approach, should be equal. And where they're not is kind of interesting in an academic sense. These statistics are kind of calculated and collated according to what's called the System of National Accounts, or SNA. And you'll find some details on that SNA at the UN Stats website, where they describe the methodology in depth. And if it's not on that website, you can also find a detailed description on the Statistics New Zealand website, as well as on the Australian Bureau of Statistics. So, in practical business economics, how would we use this kind of GDP statistic? It is very broad. So, first and foremost, it's going to be answering that really important question that we all get asked. How is the economy doing? And as soon as you hear that question, or as soon as you see that question, you think, okay, I'll just go grab the GDP statistic and then I can have an intelligent conversation about that question. And then apart from that, basically what it's going to be used as is like a good introduction to any analysis that I've done as a professional economist. I've often found that including the GDP statistic at the beginning of the presentation or just at the beginning of the report, just to couch the whole analysis in something kind of familiar to the audience, even if the actual statistic is not actually that relevant to the current analysis, but it's helpful. The next statistic I want to talk about is called inflation. Now this has got a very specific definition. It's defined as the rate at which the general level of prices for goods and services rises over time. So the way we construct this is we use what's called the Consumer Price Index, or we might use the Producer Price Index. For this module, let's just focus on the Consumer Price Index. So what that is it measures the changes in the prices of like a fixed basket of goods, and those goods are going to be purchased by kind of typical households. So it's very much consumer focused, and it's focused on the sort of items that we buy. So it's going to be coffee, bananas, biscuits, just things that we buy. To construct the Consumer Price Index, what the Statistics Agency will do is they'll devise kind of an average basket of goods from what they already have in their consumption data. So they might say, okay, we've got 100 households in our economy, and each of these 100 households spends some money on coffee, they spend some money on bananas, they spend some money on water bottles. And then we'll kind of add those things up and construct this idea of how much of each item kind of takes up what proportion of a household's budget. And that's this kind of idea of a basket of goods. And then the Statistics Agency will actually do a survey of the prices of those goods. So at time of recording, it's late 2024, and Statistics New Zealand still uses the methodology where they hire people to go out into stores all around the country, at supermarkets, large department stores, and they also survey some smaller stores. And each of these surveyors goes out and records the price of specific goods. And then they've got some kind of terms in their surveys where they allow for some deviation in kind of what quality and kind of goods, because sometimes goods just aren't stocked at certain places. So from that survey data, the Statistics Agency will create a weighted average according to the basket of goods that they kind of decided was going to be the average basket. And that weighted average is called the Consumer Price Index. And then from that one statistic, if you track that over time, you can calculate the inflation rate, which is just going to be the rate of change in that CPI or Consumer Price Index, which is calculated as the CPI for this period, or CPI underscore T, divided by CPI for last period, or any amount of periods back. And then you subtract 1 from that, and if you would like to, multiply the whole thing by 100, and that gives you the percentage change. And then you could report that as the inflation rate for 2024, the inflation rate from, say, December 2023 to December 2024 was, 9%, and that would be a useful statistic and something interesting to talk about. And that would mean that the average basket of goods increased in price by, on average, 9% over that 1 year's time. So, kind of in practical business economics, how would you use inflation? Well, understand that it measures the average price increase experienced by the average household for the average goods, kind of on average. There's this whole line of averages. So really it's going to be a very broad statistic, but it's kind of useful for understanding when you might want to reconsider your pricing strategies. So over the last 5 years, kind of from 2019 to now the end of 2024, we've seen really, really high levels of inflation in kind of most of the developed world, right? And so most of us should actually be considering that if our prices haven't changed since 2019, then they could be really, really low compared to our competitors, and actually just really, really low compared to what we need to live. So maybe it's time to start looking at your pricing. And the CPI can give you at least some indication of when that might be justified. And then of course, pricing is a two-way street. So you need to look into some other data. You might need to look at some more contextual pieces of information, talking to your customers, all that process. But this at least starts that logic. The next statistic I want to cover is the unemployment rate. This is a very used and abused statistic, but it's useful to go through the definition properly. So the International Labour Organization actually has a globally recognised definition of this statistic. A person is considered unemployed only if they are not working currently, they also have to be available for work during the reference period, and they have to be actively seeking work. So you can already see there's three key requirements, and especially the third one is really, really subjective. Because what does actively seeking mean? And actually also what does available to work mean? So it's not as simple as counting the number of people who are just not working, and it's also not as simple as counting the number of people who are receiving some sort of unemployment insurance or receiving unemployment benefits. So I've kind of picked three countries that I'm familiar with, and just to go through some ways that these countries calculate the statistic. So we've got the USA, New Zealand, and Australia. I'll go through New Zealand specifically because I live here and I'm kind of familiar with that process. So the Statistics New Zealand starts with a survey of people who are aged over 15, and there's a few thousand people who are surveyed every quarter, and you fill out the survey multiple times during that quarter. So basically, you fill out the survey and it asks questions on how actively you're searching for work. It asks questions on whether you're available for work. And then with that information, Statistics New Zealand will calculate the official unemployment rate. Now what's interesting about the different ways countries calculate the unemployment rate is that most countries have a slightly different definition and slightly different implementation of the definition. So for New Zealand, it's everyone over 15. Then the active job search is going to be for the past 4 weeks. The availability for work is the next 4 weeks. So that's a really broad window. But then if you look at somewhere such as Australia, the active job search is required in the past 4 weeks, which is similar to New Zealand. But then the availability for work, to be unemployed, you have to be available pretty much immediately, next week. So someone in New Zealand, say, is not working, and they are looking for work, but let's say they've got a broken toe and they just can't work for like 2 weeks, let's say, for that reason. Then in New Zealand, they would be unemployed, and in Australia, actually they wouldn't be. So when you're comparing unemployment rates between countries, it's helpful to understand these little nuances that might affect how many people might be unemployed in one country versus another. And then the last kind of point about unemployment is there's this idea of discouraged workers, which is actually a really important idea. So in that definition of unemployment, we said people should be available for work and they should be actively seeking work. So these are people who are kind of maybe doing well mentally. They're kind of okay. They're like, okay, things are kind of bad, but I can get along, I can search online for jobs, I can go to interviews, I can be actively trying to fix that for myself. But then there's this idea of discouraged workers. And these people are people who, they're not working, they are available for work, so they don't have a broken toe, but then for whatever reason they are discouraged. They're not actively seeking work, and from a policy perspective, that's been an area of significant research in New Zealand, and I know it has been in Australia as well. And unfortunately, these people are just not included in the official statistics, so we have to either track that separately or we have to model it separately. And the US is really kind of unique in this regard, or at least within these three countries. I know that the US actually tracks the discouraged workers within a survey, which is really interesting. So I just want to kind of emphasize that the unemployment rate is kind of connected to the number of people who are receiving an unemployment benefit. As if you did survey those people, then there's a high likelihood that they would answer the questions sufficiently to actually be unemployed. But actually there's going to be a lot of people who are receiving unemployment payments who are discouraged workers, and they would not be unemployed. So we have to understand that the number of people receiving the unemployment payments, whatever that's called in your country, that's not the official definition of unemployment. You must use the official definition, which is that you are not in work, actively seeking work, and available for work. And so, that's a common misunderstanding. And you'll often see different pundits kind of quote, how can unemployment be? This was actually a story in New Zealand, I think, last year or the year before. How can unemployment be 4% when there's, I think it was 200,000 or something people who are on the unemployment benefit? Anyway, this is the answer. They're calculated differently, right? They're for different purposes. So how would you use kind of the unemployment rate practically in your business? Well, really, I think that it's a vibe check, right? And that's a very specific word. So being unemployed really, really sucks in a lot of different ways. A lot of different ways that we just don't have words for. It just sucks. And so we can kind of get a gauge of how well people are doing in the economy, even if the GDP number is increasing really rapidly. If this unemployment unemployment rate is also increasing, then people are just not having a good time, in all sorts of different ways. And basically we say that, the unemployment rate increasing is bad, and if it decreases, it's probably good, within certain bounds, right? Okay, so we'll just take a short break here. Okay, so I hope you guys had a chance to have a bit of a break. I need to take a breather. So if you have any questions, just put them in the community forums, and we can go through those kind of over the next few weeks and see what we can learn. But it's time to get back into the module, so we'll start off. And the next statistic I want to introduce you to is population. So there's a specific definition of population, or actually there's two, and these are kind of guided by both the UN and the World Bank. So there's this idea of de jure population and this idea of de facto population. Now the only difference between these is that de jure population is a count of people who are usually resident in the country, even if they're kind of away from the country at the time that you ask them where they are. And then de facto population is kind of everyone kind of in the country, even if they're not usually resident. So this comes up kind of every time we do the census in New Zealand. We'll have some people who are tourists coming to New Zealand, and the census will be sent out. And because they are technically in New Zealand, they are kind of counted as part of the population. And then there is some questions in the census that kind of flags them as not usually resident. And that's interesting statistics in itself. And kind of for the official population estimates, which are kind of a separate statistic, most countries use the de jure approach. So how do we construct a statistic for the population? Well, usually we do it using a census, which is like a country-wide survey of pretty much everyone, and most countries really do try really quite hard to make sure they capture pretty much the whole population. Within reason. There are people who simply are just unable to be surveyed. So it happens every kind of 5 to 10 years. And the last census in New Zealand took place in 2023. And also, when they send out the census, it includes questions on how old you are, how many people are in your household, what ethnicity you are, also some questions on what gender you are. So it gives policymakers a really good perspective on kind of who's in the country and what they look like. I guess that's a strange way of saying it, but I guess kind of what they look like statistically, and put people into groups. So, but for kind of practical business decision making, a census and a population estimate is not as useful as it would be to a policymaker, but it is still useful. I think it's really good for as a first contextual point if you're kind of looking to identify opportunities, or if you're trying to justify an opportunity, or if you're trying to model something. You might need just a count of people who live in an area for a model you're building. But basically, what we would probably want to see is that growing areas would possibly mean that there are possibly growing opportunities within those areas for your business. And demographic data can help a lot too. So we might see that certain areas are changing demographically. We might see that certain areas are younger on average. The last piece of data, the next piece of data I want to cover is incomes. Now, income data is really complex. There's actually several ways to measure incomes within kind of the whole statistics profession and economics. But what we really want to dig down to is this idea from the System of National Accounts, or SNA, which is that we're looking at primary incomes. So we're looking at the income that people and kind of other factors of production derive from being part of the production process. So again, that was part of the last module, right? We looked at the production process. So people and kind of assets and other economic agents are involved in that production process, and they derive income from that. And so that's what we call their primary income. So Statistics New Zealand collects this data in New Zealand, and the Australian Bureau of Statistics collects this data in Australia. And in the United States, there are actually several statistics agencies, and I believe it's the Bureau of Labour Statistics who collects primary income data specifically. So how would we construct this in kind of several different countries? Well, I've got kind of a summary from New Zealand, the US, Australia and Europe. Just these are kind of four broad areas I'm reasonably familiar with. So in New Zealand, income data comes from the Quarterly Economic Survey, QES, the Household Labour Force Survey, or HLFS. That was that same survey that we use to calculate unemployment. We actually also ask about what people's income are, which is interesting. I should also say that it's also collected as part of the census, and as well, income data can come directly from the IRD, which is our tax department. They don't release the data publicly, but if you are an approved researcher, you can get statistics on income from that department. And so there's different types of income. There's kind of weekly earnings, which is income week by week, and that changes, and that it's interesting that changes. And then there's kind of this idea of household income, which also does change, but it changes a bit more slowly. And so we see different patterns in these two income kind of types. The surveys are done kind of quarterly, which is common for surveys, and the census is every 5 years. And then that tax department data, that's actually available daily, which is interesting. But you have to be in a special club to get access to that. And then kind of the last area kind of related to income is this idea of disposable income. So this is where kind of New Zealand falls a bit flat, and it's regrettable, honestly, as a professional economist. Up to about 2018, we had a survey called the Household Economic Survey, and this survey asked people what they spent on different goods of different types, and then from there, because it also asked their income, we were able to understand what their disposable income was after all their expenses. And that was really interesting, and it was really helpful for policymakers and other researchers. Since 2018, that survey has kind of not been produced and not been collected anymore, and so that's a bit regrettable. But for the US, Australia and Europe, all those areas have some sort of survey or some sort of official statistic for tracking disposable income. Yeah. So how would you use income data kind of for practical business decisions or business economics? basically, I feel like it's a good indicator of whether people in an economy are becoming better off. If it's going up, then that's good. Going down, that's kind of just bad. It's also a really good starting point, or a really good rough starting point, I guess, if you're doing a sort of analysis of affordability. Can my customers afford this? Well, okay, what's the average income in your country or in your area, if you can get the data? And then make some assumptions, be like, oh, okay, well, I know if the average income is $2,000 a week, I know that rent is maybe $700 a week, other expenses are taxes, and subtract all those off, and then figure out, oh, okay, my potential customers maybe only have $10 or so left each week. Maybe this is not such a good area to release my product, or maybe I need to change my offer a bit. All those sort of questions. It's at least a good starting point for those questions. And the last kind of contextual data I want to talk about is wealth. This is really interesting academically as well as kind of in the policy making space. So the way we define this is that wealth is land or other fixed assets, less any debt associated with them. So really importantly, this excludes financial assets. So if you're looking at wealth distributions in any country and thinking about, oh, there's inequality, we have to realise that a lot of the people in kind of that lower wealth group are going to own some financial assets. And that's true also of the people in the higher wealth group too. But, you should always take the constructed wealth inequality statistics with a bit of grain of salt, because there's a lot of things that are excluded. So the way we construct wealth statistics is not done kind of as an official statistic. It's usually calculated kind of on the side, either by the statistical agency or just by academics or policy professionals. But what we do is we use the System of National Accounts, the SNA, to measure kind of wealth across countries, because the SNA collects data on sometimes it collects data on assets, it collects data on the incomes from those assets, and that's the most important part. And then kind of Australia, New Zealand and the US actually have central banks that track a lot of data, and some of that data includes data on household assets and liabilities. But again, these exclude a lot of different types of assets. And then essentially you just kind of mash those two sources of data together with some assumptions, with some modelling, whatever you need to do, and you come up with this kind of wealth estimate. So how would you use kind of these wealth statistics in practical business decision making? Well, really this one's kind of tangential. It's kind of just interesting to know. It is really mainly policy and mainly academic, but potentially you could use it as context for some business problems. Particularly if you're in the NGO space, or you might be in the non-profit space, even charity, or maybe your business is just fundamentally concerned with kind of wealth inequality, and then it could be useful as context for those sort of businesses. So that's the contextual data done. I want to move on to direct data. So as before, kind of there's a spectrum of data, right? There's the contextual data, which answers those big broad brush questions, and then this is the direct data, which answers not small questions by any means, but they are smaller in scope. They're more direct. That's why I call it direct data. And so basically, from what I understand and from my experience, direct data is mainly going to be constructed using the same data that's used to create contextual data. It's just kind of constructed in different ways. But there are some exceptions to this, and they are kind of exports and imports data, which is actually available in really high granularity in most countries. There's data on building consents, which is usually tracked by local authorities, as they're called in New Zealand, which is like a local government organisation. And then there's data on house sales. Now, house sales data is not available publicly in New Zealand for free. You can pay a subscription to get access to that data. And then there are some other pieces of direct data that are also not even produced by the official statistics agency, like electronic card transactions, although in New Zealand the official statistics agency publishes that data, but they kind of have a deal with the person who produces it. So for direct data, it's really useful to understand that these data are usually disaggregated either by industry or by area. Usually it's not both. Usually if you want the data disaggregated by both, you'll have to model it yourself, making some assumptions, some caveats, or whatever, because there's usually an idea of the statistics agencies don't want to give out information that could reveal something about people living in an area and reveal their privacy or compromise their privacy. So there's kind of rules around what they can produce in terms of those disaggregations. So we'll look at how statistics agencies kind of think about industry. So within Australia and New Zealand, we have a system called the ANZSIC, which is the Australia-New Zealand Standard Industrial Classification. And that's organised into levels. And these levels kind of start very broad, and then they get really detailed. So we'll start with kind of division. They use just one letter. So I know that A is agriculture. And, and that's kind of agriculture, manufacturing, finance, really broad categories. And then subdivision kind of breaks out those divisions into subdivisions. So within agriculture, there's sheep, beef and dairy farming as a subdivision. The group is the next kind of subdivision of that, and then kind of that's within sheep, beef and dairy farming, you've got just sheep farming. And then there's a class under there, and so that might be sheep farming for meat or sheep farming for wool, even though those industries are usually actually the same business unit. Most farms, at least in New Zealand, who farm sheep for meat also share their sheep and sell the wool. In North America, or USA, I think this is also used in Canada, but I need to check that too. But at least in the USA, they use the North American Industrial Classification System. And that's kind of just, it takes the ANZSIC, or it's not based on the ANZSIC, but if you think of the ANZSIC, it's kind of just bigger. So it's organised into similar kind of sector, subsector, sub-subsector kind of units, going from very broad to very detailed. I'm not as familiar with the NAICS as I am with the ANZSIC, so I can't tell you exactly what's within these groups, but the broadest one, again, is going to be things like manufacturing. And if you are curious, maybe a bit of homework for the experts, is see if you can use the Statistics New Zealand website or use the Australian Bureau of Statistics website and see if you can find the concordance between the NAICS and the ANZSIC. Because I know it is published on both of those websites, and it would be really interesting to see how many of you can dig that out. Post in the forums how long it took you to find. And yeah, that concordance kind of, it's not immediately useful for your work, but it's something I've used occasionally a few times in history, and it's good to know that it exists. So kind of finally, we've been through so much this module. We've been through contextual data, we've been through direct data, we've been through how industries are classified. I kind of didn't publish in here how the areas are classified, because area classification is different with every statistics agency, and it's actually different with different statistics too. So maybe area will leave for a community forum discussion, or maybe we can have a webinar or something. We will go through it in future, but just not in this module. But I want you to kind of leisurely browse some data sources. You've got Statistics New Zealand, you've got the Australian Bureau of Statistics, you've got the FRED, which is the Federal Reserve Economic Data, and Trading Economics. So we'll quickly go look at these websites. So this is Statistics New Zealand's website. You've got statistics, and they publish, you can navigate through that way using these drop-down menus. That's kind of interesting. Got the Australian Bureau of Statistics. This is a reasonably interesting website and reasonably useful and not very difficult to use, although I must say that the Statistics New Zealand website is a little bit easier to use. And then actually really what is the gold standard is the FRED. this Federal Reserve economic data. It's not so easy to find specific statistics that you're after in terms of any logical classification, but what makes it great is the charting function that they have. So they produce a chart, and if you're clever, you can actually add different series to this chart, and then have a chart that you kind of wanted to build yourself, kind of built for you, and that's actually really useful. So I do like that website. It's really cool, and yeah. And then the last website is odd identification. Okay, so the last website I wanted to show you was Trading Economics. This is one of kind of several services available globally that tracks data from pretty much everywhere, like inflation rate. They take data from literally every official statistics supplier, and they bring it all together, and then they charge like a monthly or yearly subscription to access the data. You can access the data kind of broadly, and just to look at a graph, and you can download the graph. But if you want to download the data, you'll need to pay the subscription, and that can be worthwhile. That's kind of an individual decision. Is that worthwhile for me? Yeah. So I hope you've enjoyed this module, and we'll have a look next time at the next module.